$1.5 trillion in treasuries, and if they stopped buying, the dollar would collapse and they would lose money on all these treasuries, right? Americans are always worried about how much China will lose if the dollar collapses. What about how much America will lose? Because that's all we got. But the Chinese, believe me, are not thinking about the $1.5 trillion they already have. They're thinking about the 5 or 10 trillion that they're going to be required to buy if they keep this up over the next few years, because that dwarfs what they already hold. It's not just incremental. We're not asking them to buy a few $100 billion. We're asking them to back up the truck and go all in on the dollar, right? And that's what scares them.
This is an interesting question, given that you are starting to accumulate more precious metals. Can you comment on, and this particular question is asking you to comment on silver and banks that are issuing paper or service without any physical silver backing it? Is this the next shoe to drop? Is this a short?
Well, I don't know what banks are doing this.
Well, there's
Max Kaiser, JP Morgan.
Yeah, probably the bullion banks. JP Morgan is the leading one. There's a lot of
So people are buying silver from them, and they're getting a certificate that says we have silver for you, but they don't actually have it.
They don't have the physical. They don't have the physical.
Well, why would somebody even buy a certificate from them if they know they don't have the physical?
they lend it out. They lend to their third parties.
Oh, they've loaned it out. Yeah, well, that is very dangerous because they might not get it back. Because the people who borrowed it from them might not be able to get it back. So yeah, the idea is when you own gold or silver, one of the beauties of it is that it's not somebody else's liability. So don't buy it from somebody who doesn't have it, because now you've taken silver and you've introduced an element of risk that by definition shouldn't be there. So if you're going to buy silver, make sure that you either take possession of it. If you're going to own it, in an ETF where there's auditors that are saying, of course, auditors have said things that weren't true, but they're not. But if you know that it's been loaned out, right, you are taking a risk because you have a counterparty, and that counterparty, especially if the person who borrowed the money, who borrowed the gold from JP Morgan, went out and shorted it in the market. And now that they don't have it either. And then the price goes way up and they can't afford to buy it back. So they tell JP Morgan, I don't have the money, so I'll take your silver. So now what are they going to do? I mean, of course, they might get bailed out by the U.S. government and give them money, but of course that will make silver prices go up even more. But you're better off, unless you're trying to leverage your silver. See, some people want to buy on margin, and therefore they have to give their silver to a third party as collateral to get a loan. But then, of course, you're introducing a whole speculative element. But if you're buying unleveraged silver, either store it yourself, or have it someplace. We keep silver for clients in the Perth Mint in Australia, where it's required by law that it's there. They can't loan it out. I also have a company, EuroPac Canada, that we deliver silver and gold to your house, and you store it yourself, put it someplace. And you don't want to buy it from somebody who doesn't have it, and you don't of course you don't want to get conned. There are a lot of people now that are buying these antique coins, and people are paying $2 for $1 worth of silver. You don't want to do that. You don't want to buy. You want to buy bullion. Even coins are embargoed, but you don't want to buy antique or collectible coins or rare coins. When you're doing that, you're making some salesmen very rich because the markups are horrific. I'd say the markups can range from 20, 30% to 70 to 100%, and all that markup is the difference between what the dealer pays and what the client pays, and that's a huge difference. And of course, when it comes time to sell, the price has to go up dramatically for you to overcome that. And a lot of times too, numismatic coins. Numismatics can be good investments over the long run, the same way a baseball card might be, or other memorabilia, or an impressionist painting, or a stamp. But it's not a bullion investment. Just because a rare coin is made of gold or silver, when you buy a baseball card, you're not investing in paper. It just happens to be printed on a piece of paper. So, if you spend $20,000 for a 1 ounce gold coin, you're not buying gold. You're buying something that's rare and unique and beautiful. But the problem is when you need to sell it Somebody might not want that rare, unique, beautiful coin. They might only want $5,000 for it, even though the price of gold has doubled since you bought it. You might only be able to get $5 grand for it because the price of gold has very little to do with the value of the rare coin.
So, at what point would you consider selling gold from an investment perspective?
Well, I'm not considering selling it now. And of course, you don't actually have to sell gold. You can use it. You can buy things with it. And you don't actually have to go back to paper. You can take your gold and you can buy somebody's car. You can, you can certainly use it as money. It is money. But when would I think it would make sense to trade money for paper? Well, things would have to be a lot different than they are now. Now, the last time we went from a bull market to a bear market in gold was in 1980, 1981. And a lot of things happened then, right? Paul Volcker, who was appointed under Carter, but really came to his own under Reagan, he raised interest rates up to 20%. Reagan came in, Republicans took the Senate, he came in promising to abolish the Department of Education, abolish the Department of Energy, government is the problem, markets are the solution, slashing taxes, cutting spending. So you had a combination of tight monetary policy and prudent fiscal policy. It didn't end up being prudent because we never got the spending cuts, but we got a lot of the tax cuts and we did get the sound money. And that combination of a tight Fed and government is the problem, the markets are the solution, that turned. And if you had recognized that, you could have sold your gold and moved into bonds and stocks and rode a 20-year bull market. Now, you probably would have sold gold when it was at 800, right? But you might have sold it somewhere between 400 and 500, which is where it was for most of 82, 83, 84, 85. Now, if you bought gold at 800, you were pretty much screwed. I mean, there was no way to get out and make money. But that bull market started when gold was at $35 an ounce in 1970. So if you recognize the problems and you bought your gold at $35 an ounce, $50 an ounce, $100 an ounce, even if you didn't get out at 800, getting out at 400 or 500 was fine. And you were able to buy bonds that were yielding 15%. You could have bought 30-year treasury 15%. You could have bought the Dow Jones with a 6% yield at 1,000. So you could have rode a big bull market. Now the question is, are we going to have a situation in the future that is similar where we need to get out of gold and back into bonds? And maybe you started with 1 million, or you bought gold at 1,000 and you sold it at 2,000. So you doubled your money, right? So you went from 1 million to 2 million. Right? And now the dollar collapses. See, people say, I want to preserve my gains. I want to make sure I keep that extra million. Well, if the dollar collapses and chewing gum is $1 million a pack, well, all right, you got 2 packs instead of 1. What's the big deal, right? So you can't be too early. You got to make sure that the coast is clear. And what that means is you can't sell the top. Don't even expect to sell the top. In fact, there probably will be a blow-off at the end, and you can't know where that top is. You don't have to sell the top. Even if you sell, 70% of the top, it's way above where it is now. But you have to make sure that the governments have done the right things, that it's safe to go back into paper. And we know what has to be done for that to be accomplished. And before that is accomplished, there's going to be a lot of economic pain. Much more economic pain than we had in 1981-82. It's going to require a much bigger sacrifice. It's going to require politicians to do things much, riskier than what was done at that period of time. So yeah, I'm hopeful that I will one day want to buy, U.S. assets again and paper, but we're nowhere near there. I mean, we're still early in the bull market for gold. We're still making mistakes. We're nowhere near correcting it.
So, what do you think of South America and Asia, and is it best to access those markets through exchange-traded funds or direct equities?
Well, I like to do it directly. If there was an exchange-traded fund that had the exact mix of stocks that I like, then I guess I would buy that fund. But I like to pick the stocks myself. I like to pick the stocks that are best positioned for the world the way I believe it will evolve. That's all about investing, is looking at the way things are. We're not looking at the way things are, we're looking at the way they're going to be. And so I want to buy stocks that I think are positioned for the world the way I think it will evolve into. And so I like to pick my own stocks. And so that's what we can help you do, is pick the stocks that, based on my view, are the ones that you want to own, and the countries that you want to own, and the currencies that you want to own. And it's not hard. I mean, it's a lot easier to buy stocks in foreign markets than it was years ago.
So you can't have a portfolio entirely full of commodities. What is the proper asset allocation for Canadians? Should it also include Canadian bonds?
I think individuals kind of have to decide for themselves, what they're comfortable with, what they want to do, what their circumstances are. There's no reason why you can't own Canadian bonds. I would not own long-term Canadian bonds. I do believe interest rates are rising, which means bond prices will be falling. So that to the extent that you want to have some bonds, keep the maturities no more than 2 to 3 years, and wait for rates to rise. And when they do, you can roll over into higher rates. But I think that there's better yields for people who need income. There's better yields to be had in equities, so I favor equities. But not all equities are the same. There are equities that are a lot less risky than others. So you look around and you try to pick the kind of equities and realize that if you're getting a good dividend yield, you can take the volatility. And what a lot of people don't understand is, let's assume that you need 7% on your money to live the way you want to live. Well, you can't really get that in the bond market now. You might have to just, take 2 or 3% and just eat into the principal every year. Well, that's a loss. So why not just buy stocks? And if the price of the stocks goes down, it's okay because you're getting the yield. And if you're buying good companies, years from now the stock prices will probably be quite a bit higher, even if they potentially go down in the interim. But meanwhile, if you're buying for the income, it doesn't matter what the stocks are priced, as long as you're not selling. And a lot of people are afraid, I don't want to buy this because it might go down. Well, so what? Who cares if it goes down? And as long as you buy it at a good price, it doesn't matter if somebody else buys it at a better price. What matters is, you didn't overpay, you're getting a good dividend. And you have no reason to sell the stock. Why would you sell it? Because you have to replace the income. So you're not going to sell it. People have to psychologically get used to the fact. And people, and the thing about stocks is they're publicly traded, so you can actually see what they're worth every day. People would go crazy if, your house was publicly traded and every day there was a price there. But nobody cares what their house is worth day to day. Because it doesn't matter. So the fact that these stocks are trading, we do a lot of private investments. You buy a stock and it's never trading. It's a convertible preferred, so they never worry because they never see the price change. But technically, theoretically, the value is changing every day, even if there's nobody transacting.
If the U.S. does go through a period of significant inflation or even hyperinflation, how will it